Are you prepared for the shift that's changing what clients expect from their financial advisor? Today's financial professionals are navigating a very different landscape than they were even just a decade ago. As clients experience liquidity events, tax complexity, wealth transfer decisions, and increasing interest in alternative investments, the advisor's role is evolving from managing portfolios to engineering more panoramic outcomes. Welcome to the Always On podcast. I am your host, Duncan MacPherson. On this podcast, our objective is to enable financial advisors to always be working on their business and on themselves. And on today's episode, I'm joined by Matt Doran. He's a partner at And Partners, where he leads advanced planning and helps financial advisors navigate complex tax, charitable, and wealth transfer strategies. Together, we explore how advisors can reposition themselves as trusted coordinators of their clients' entire financial life, why alternative investments should be positioned within a process rather than pitched as a product, and how embracing complexity can strengthen client relationships, increase your fee worthiness, and create lasting, growing enterprise value. Well, there is a profound shift occurring in the financial services sector. The emergence of two AIs. Artificial intelligence is revolutionizing how a financial professional will conduct himself or herself and interact with their clients. And then the other AI, alternative investments, which presents as much disruption and opportunity as artificial intelligence. As you probably noticed in the last 5 years, pretty much out of nowhere, the alt space has now, it exceeds $20 trillion. Many people say it's going to go well over $30 trillion by 2030. What I want to accomplish today is I want to talk about your mindset around positioning alternative investments within your process instead of pitching it as a trade or a product. And I want to talk about the mind share that you earn within your clients so they understand that you're not being opportunistic, that this is you leveling up and evolving. And very, very quickly, we're going to talk about how to future pace and get out in front of this tsunami of liquidity events that's occurring in many of your clients' lives. And to have this conversation, I have just a terrific guest. Matt Doran is an advisor to advisors. I've gotten to know him very well over the last few years. He leads advanced planning at And Partners. Matt, first of all, thank you very much for making some time. I know you're a really busy guy.
Happy to be here. Thank you.
The needs of high net worth clients are becoming more complex. The role of the financial advisor who's interacting with those clients has become such a huge responsibility. And Matt, I love your technical expertise. The conversations that we've had have been mind-bending in terms of how this is actually evolving. I think I underestimated how significant this addition to the financial advisor's responsibility has become. But one of the reasons why I wanted to have you here is because you also appreciate the importance of best practices, standard operating procedure in terms of how the advisor conducts themselves with their clients. And then lastly, and this is where we'll segue, your understanding and appreciation for the importance of a diagnostic approach to helping a client of a financial advisor come to their own conclusions about the role alts can play. So let's get into this. First of all, talk about your role, a day in the life, and how you show advisors to both get access to alts, but also to be active in the positioning of alts. So let's just ease into that.
Yeah, so thank you again. So as you mentioned, I lead the advanced planning effort in Partners, which really means all things financial planning, but most of my day-to-day activity is meeting with practitioners and or their clients on specifically tax planning, charitable planning, and wealth transfer, right? And I believe that those are the three most underserved areas of wealth management, which we'll get into. There are good reasons why that has been the case, but it's rapidly changing. And those are the areas where I think a team approach and a good supporting cast make a huge difference in the way that advisors serve clients today.
Yeah, there's no question. So just to sort of simplistically address the shift. So my view is that the traditional model of 60-40 of equities and fixed income has, and nothing stops this continuation, this evolution where it's effectively becoming 60-30-10, and I've seen all kinds of variations on that. The fact that you interact with advisors and their clients in real time, talk to me about some of the diagnostic elements. And I say this because, Matt, last week I had a conversation with an advisor, and I respectfully called him out because I said to him, I said, I ask you one question, I get 5 answers. And I know there's a temptation to try to impress somebody with your technical ability. But I think what's really important here is to impress upon them that you're interested in what's in their best interest and what's the best fit. So talk to me about how you bridge that, and give me a scenario. If you're sitting with an advisor and one of his or her clients, and it's very complex, charitable giving, family transfer, all of that. Talk to me about your diagnostic approach to bring alts into that conversation.
Yeah, so more and more commonly, the conversation centers around a liquidity event, right? And the liquidity event, when I started in the business, was somebody was retiring and the money they had been putting away in a pre-tax retirement plan was rolling over to a different structure, right? But that's not what's happening now. The liquidity events are vast and varied because wealth is being created in vast and varied ways and sometimes very suddenly, right? An extreme example of that might be NIL money. I mean, you have college athletes and signing bonuses for those who make it to the next level, and very sudden wealth creation. But the more common situation that I'm involved with is somebody is exiting a large real estate holding, or they are selling a business, or they have a lot of equity compensation. So think about the most recent IPO with SpaceX and the ones that are anticipated with other companies like SpaceX. You've got a lot of people there who have incentive stock options and other types of equity awards that create wealth very suddenly. And there's a lot of planning, particularly around tax, and making sure that that's done well. Right? So it's really about liquidity events, and they're coming in vast and varied forms.
Okay, so critical life events, liquidity events, ultimately future pacing enables a financial professional to get out in front of, but as close as possible to any and all forms of money in motion.
Right.
And so as we've talked about before, the big distinction between pitching and positioning, first of all, the benefits are the advisor has to reimagine what it means to be the first call, where a client understands they're always contacting their advisor before any significant decision is made, never after. And I don't know about you, but we're seeing that happen where advisors get almost like an afterthought in some ways because the client didn't know that they could play a role in a complex decision because the advisor sort of painted themselves into a bit of a corner based on 60-40 and other forms of representation. So first call I want to talk about based on money in motion and liquidity events, total client engagement as the client's life unfolds and their needs evolve. That perception that they can't outgrow the advisor because they're actually growing into the advisor's process. So,
yes.
So first call, total client engagement, and fee worthiness. Alternatives and this positioning, there's an opportunity for a client to have a refreshed perspective on why the advisor is compensated rather than how much they're being compensated. So with that as sort of like three of the many benefits that come from this positioning, again, let's get into the weeds on how the advisor's role has evolved, the client's needs have evolved, and how that's actually accomplished, like based on your scenarios.
Yeah, and I think that's a great place to unpack what has changed in the world, because that's what's led to what's evolved the financial advisor's role and responsibility, right? So you sort of laid out the career progression for many people who have been in the seat now for a long time, where they started as an investment rep. Nobody really liked that term, but it was pretty appropriate for what was happening at the time.
Right.
We were representing investments for people who would obviously benefit from owning them. Then we moved to financial advisor, which was the evolution into I'm really not a salesperson. I'm providing strategy and advice to people, but that was limited to things that weren't very far outside the portfolio. And the people we're talking about now, Duncan, or the ones that we should all be aspiring to be, are the wealth managers, which is the one that doesn't ignore the things outside of the portfolio. In fact, recognizes that those things are in many cases much larger and have bigger implications than the things that are in the portfolio. So the key to being the first call is understanding how to navigate complexity and change. And that's really what has helped the advisor role to evolve, was the needs of the clients have evolved too. And what they need from their advisors now is different than it was when I started in the business. So a quick history on that I think might help. And that is, if we went back one full working career from where we are right now, that's 40 years ago, and we're in 1986, right? Well, in 1986, greater than 80% of all people in large and medium-sized companies had pensions. But life expectancy was ever increasing and interest rates were on the decline, and that lasted for a long time, which makes a defined benefit hard to support, right? So gradually there was a shift. It felt like it happened overnight, but gradually there was a shift from defined benefit to defined contribution. And I believe that set off a whole other host of social changes, including mobility in the workforce. If I'm not going to get retirement income and retiree healthcare, I might be incentivized to invest in my own skill set and look for a better paying job or start my own business, or you get it. But what really happened was the burden for retirement became one of self-funding. And in that period of time where everyone needed to own more investments, you saw a proliferation of account types and investment vehicles, and you saw Simple Plan and Solo K and Roth IRA and Coverdell and 529 were all born at this time, and it was coincident with people needing to take more responsibility for their outcomes. But now, here we are, many, many years later. The IRA was born in the early 70s, the same thing with the 403B, the 401k in 1978, widely adopted mid-80s. These accounts have been around for 45 and 50 years now, so people come to the table with investments now. And at the beginning of my career, that wasn't true. We were becoming a nation of investors at that time, and not necessarily willingly. It was out of necessity. And I don't really believe that employers abandoned their employees when they switched over from defined benefit pension plans to defined contribution plans. But they did create a lot of new compensation tools, including stock ownership programs, RSUs and options and employee stock purchase plans and ESOPs and various different things that allowed employees to participate in the ownership of the business and create alignment so that everybody was focused on the business doing well. But that created a lot of complexity and timing issues and different tax treatments that really didn't exist in my grandfather's generation. Mm-hmm. And so it was the need to navigate that complexity and coordinate those moving parts and timing issues that helped the financial advisor's role evolve to being more planful, more strategic, and less in the business of just promoting an investment that might be suitable. Mm-hmm. And in summary, I would say that people hire advisors today to play a lead role in engineering the outcomes they seek, which is very different from selling the inputs that might get them there.
If you're like most advisors, you're constantly balancing two priorities: growth and consistency. That's why we built the Turnkey Advisor membership, a community of like-minded advisors who understand the importance of working on the business, not just in it. Membership includes proven strategies for growing, teaming, scaling, or exiting, with full resources and support, including access to Pareto Academy, things once only available to our private coaching clients. If you're serious about bringing structure and stability to your business, this is where consistent results are achieved. Learn more at paretosystems.com/turnkey.
Okay. Phenomenal statement, response. I said to an advisor last week, back to your point about that shift from salesmanship, the fixation on products and pricing and performance, transactional. I said to the advisors that how much better is your life and your alignment with your clients because of advisory, because of your shift to advisory. And we had this amazing conversation how it expanded the client's thinking about the advisor's role, impacted fee worthiness, and helped them get eyes on assets that the client had that were outside of the advisor's process. The second home in Tahoe or anything that they've been participating in outside of the advisor's purview. So I guess my point is, based on complexity, based on demography, I'm curious. Chicken and the egg. Demography, complexity, that's obviously driving some of this. But what about, the advisor's role evolving based on market forces and what created this emergence of alternative investments? Where did it come from? Is it responding to demography and complexity, or is there something else that's driving it?
I think there are many factors at play here, but the simple example is that companies are staying private longer or choosing never to go public at all. Okay. And that has to do with where funding can come from, right? It used to be an initial public offering or maybe a secondary offering or, the underwriting, the issuance of a bond or whatever. These were funding mechanisms for growth. And now that funding can come from private equity and other places that make it unnecessary to go public, or even if a company goes public but doesn't do so as early in their life cycle as maybe they would have, a lot of the growth that's associated with being an owner is unavailable to people who don't have access to private investments, right? So it's not necessarily a commercial for that. It's just a fact that there are far fewer companies that trade publicly in this country now than there were 20 years ago, whether that was a result of companies gobbling up their suppliers or merging or acquiring or not. But the simple fact that funding for growth can come from various places made it unnecessary to become a publicly traded company, which is typically how people got access.
Okay, makes perfect sense. I talked to Chris Jepson about that over at First Trust recently. I should have known this, but it was kind of shocking because he said, there's 2,800 plus or minus public companies, and there's 19,000 private companies that generate revenues in excess of $100 million annually. And you think about private placements and private credit, that used to be somewhat exclusive to institutions in terms of access to those opportunities and family offices. Now, more and more advisors have access to this. But again, why is there somewhat of a lag between access and being active? Why are there so many advisors who are late adopters in terms of positioning this into their process? Do you have an eye on that?
Well, I do think that for many years, and it goes back to the shift we were talking about, coming from a world where your wages were ordinary income, your pension was ordinary income, your interest rates were higher, so passbook savings and CDs were ordinary income, and ultimately Social Security, which is not all taxable, was ordinary income. There was definitely a strong need to leverage tax deferral and so on. Now that there's a confluence of asset types, tax treatments, and timing issues, there's a need to have different tools in the toolbox, right? And so I think that in the accumulation phase of a person's life, which goes with that timeline we were just discussing, liquidity was important for people. And they already had very illiquid savings vehicles like retirement accounts, and those retirement accounts didn't offer private equity or private investments, right? So you already had some illiquidity, and you also had some constraints on what could be invested in those environments. Mm-hmm. But now that wealth is being created in other ways, and the liquidity event is often not the retirement, but the sale of an asset, then the proceeds from that liquidity event can be invested differently. And the thing about alternatives is you can more precisely match the need with the vehicle when liquidity isn't necessarily the goal, but what about low correlation? What about an asset that isn't correlated to all the other things that I own? What about something that offers me the opportunity to mitigate my tax liability on other things that might be coming? And I just think that's become far more strategic, and the use of those things has become more widespread because of the way that wealth is being created and the change in the liquidity events and when they occur.
Okay, excellent. And I just have to ask, because we spoke, last time we spoke was a couple of months ago, I think, and I can't remember if you mentioned this or if I saw this when I was just following up, but I was looking at your credentials, and did I see that you are pursuing a master's in tax strategy?
Yeah, I completed that a couple of years back. It's actually a master's of tax law. And so if I were a JD, which I'm not, that would be called an LLM. And that's the degree that most estate planning attorneys have, because it's where wealth transfer lives. And that's why I chose that path, was because wealth transfer is really an important part of planning.
Wow, and that's got to be a massive blind spot or unmet need when that liquidity event happens. So I'm assuming, based back on the future pacing, that you're, as an advisor to advisors, helping advisors plant seeds to prime the awareness for a client to get out in front of that as far as possible. Is that impacting relevance and impact and fee worthiness?
Definitely. And the advisor is a good case study. It used to be that the role was one where you created income from the client base that you had in serving others. It's a servant leadership position, of course, but for the work that we do, we got good income. But only recently has the advisor's practice become a saleable asset. And
That's very true.
that wasn't always there. And so the advisor is an eager audience for wealth transfer strategies as well, because if they've done well in the business, and the people that you and I are talking to have, they've created a lot of wealth through their role, but they also have liquidity events on the horizon, right? And so while the federal estate exemption amount now is very, very high and only pertains to a small percentage of Americans, the population that's seeking wealth management services is highly populated with those people, right? And so the exemption is high, but it doesn't mean no one's facing it. And so the desire that people have to mitigate tax liability and keep their wealth in the family and potentially transfer it to multiple generations after them is very salient for the people we serve, including the advisors.
Yeah, very good point. That's probably an entirely dedicated conversation we could have where the advisor is effectively the client. But we'll park that one for a second. I've said to some advisors recently that you're conspicuous in the absence of positioning this into your process. Now I'm starting to get this sense that there may be an even greater risk, because I think competitors are starting to use alt as a wedge to disrupt relationships, long-term relationships. Talk to us a little bit about what's causing some migration and client defections from advisors because of some type of outside force or disruption. What's your perspective on that?
Yeah, I do believe that our business and most businesses have always been about access, right? So early on, it was about access to information or research or trades or products, right? But this is just another part of that evolution. I do believe that clients hear a lot about the role of alts in a portfolio, either to smooth their returns, create better growth opportunities or income streams, but they also read a lot about the role of alts in tax mitigation. For example, direct indexing, right? The whole idea of direct indexing and replicating an index for its returns, but then harvesting the losses of the pieces that didn't participate in those returns,
Right.
and create tax efficiency, right? Well, that isn't available everywhere. And so if somebody thinks that that's appropriate for them and appealing to them, then that's one of those wedges that you described, is that not everybody's offering that. And so there comes with it sometimes a feeling that the client or their needs have outgrown the firm or advisor that's serving them.
That's huge.
And I believe, and you've been speaking about this for a long time, the migration in our industry has been from big to small, captive to independent, product focused to advice centric for a long time for these reasons.
Great perspective. And then you put in the horsepower that clients have in their hands in the form of AI on their phones. Okay, first of all, a shameless plug. So I've got a white paper coming out on how to position alternative investments into your process, not pitching it as a product. Okay? And a masterclass, a deep dive, sequential, very methodical approach to reframing relationships. So thanks for hearing me out there. If you want access to that, just see us at Pareto Systems. Part of what's in that white paper are a couple of scenarios where clients have come to the advisor with ideas. They're at a barbecue, they're playing golf, and a friend has planted a seed about an alternative investment. And the client comes to the advisor and says, "What do you think?" I think that's a moment of truth in that relationship in terms of how the advisor responds, dismissing it, embracing it, positioning it as a part of the conversation to rejuvenate. I think there's this fine balance, Matt, between letting loyalty fatigue build in a relationship through familiarity and the perception of scope drift, where a client thinks that the advisor's drifting outside of their lane. There's a balance in there. And I think alts can play a role, but it's got to be positioned around the people practice process, not the product's pricing performance dynamic. So are you seeing that with your advisor community too, where clients are coming to advisors saying, hey, what do you think about this?
I am seeing that. And one of the things it makes me think of is that clients today need better partnership among the professionals who serve them. And the financial advisor is better positioned than most professionals to create and maintain that partnership among the professionals who serve them, right? And when you talk about scope creep or drifting out of your lane, it's really less about that and more about the awareness for the other professionals to play a meaningful role rather than always being downstream from it, right? And the advisor sits at the table before things happen. We talk a lot about liquidity events or big life events. The advisor has for a very long time been an expert in their client. But in addition to being an expert in their client, they need to have some expertise and issue spotting capabilities to know the solutions and the professionals who can execute on those solutions to solve for better outcomes.
That is such a great point around leveling up. While many advisors are still fixated on this sort of dynamic of COIs, which is fine, but I think there's an opportunity to put distance between yourself and the pack and amplify the professional contrast by rejuvenating any relationship with other service providers that the advisor has, but positioning it as a value-added support team where the advisor is the keystone. Advisors are so entrepreneurial and simultaneously focused on best practices. Many other service providers are in the weeds on technical ability exclusively. This is an opportunity for the advisor to go back and rejuvenate those relationships, position it properly, where the advisor can say, I've assembled a vast network of service providers that I've added to my process. So instead of the advisor saying, we'll refer you out where necessary. No, we're going to engage these people into the process. That positioning is massive. We've been talking about this whole CFO and complete family office and all of these different drivers. Alts can actually add fuel to that positioning based on what you're saying.
Yes, without a doubt. And the advisor's role to be that keystone could be everything from the client owns a business that they plan to sell one day. Somebody needs to talk to them about whether the entity structure they're in is most amenable to that sale, right? So we often start businesses as pass-through entities, LLC, sole proprietorship, S Corp, because we might have losses initially and we want them to pass through. But if the business qualifies and would benefit from an exemption of capital gains upon sale from being a C Corp, that's not the advisor's role to say that or suggest that. It is, though, helpful if the advisor understands that it might be ripe to be revisited. And the advisor is never going to value the client's business, but they know the people in the business who do that work. And the key, and you said something a minute ago, COI and the referability stuff used to be more sort of representative of a time frame when we operated in silos, right? I have a client who needs what this professional does, and I'm going to send them there. But increasingly, it's about what should be considered. It's let's get this other person's input on what we're thinking about, because there's probably more than one avenue to accomplish the goal. And I think the advisor is really well positioned to lead that, but it requires an understanding of the solutions and the work that the other professionals do, at least at a level where the issue can be identified and the right party can be contacted.
What is your philosophy then on the positioning where an advisor can have a conversation about things that are maybe gaps or blind spots for the client, but the advisor is not going to be compensated on identifying and addressing that blind spot or that issue? I mean, I've got to think that impacts fee worthiness and relevance and indispensability in the relationship. Are you seeing that becoming an issue where an advisor points something out and then helps the client address it, but there's no impact to the advisor's productivity because of it?
I think the impact is tremendous, and that is the elite advisors are going through a process of repositioning their value. And repositioning their value happens not only in the eyes of the client they're serving, but in the eyes of the other professionals that they're interacting with. And we hear it a lot, like, the other professionals say, well, we didn't know anybody was doing this work. And now that we do, right, it changes the landscape. And I think, for example, I go back to the things that are really underserved in wealth management, being tax planning, charitable planning, and wealth transfer. It's because they're largely siloed. And a lot of the clients that we serve have charitable intent. It doesn't mean they're leveraging charitable structures. And oftentimes they're supporting the things they believe in or hold dear in a way that isn't very efficient from a tax standpoint, like giving cash instead of something that's appreciated. And there's a lot of nuance there, but the advisor knows the client really well and knows what's important to the client well, and sees these other life and liquidity events well in advance of them occurring, and has a unique position to knit those things together. For example, if you're already in charitable, I'm not suggesting that somebody should become charitable for tax benefits, but if you know that somebody already is charitable, a charitable structure can be a meaningful lever to mitigate tax on a liquidity event. It has to do with timing, and it has to do with the right structure that might pull forward the deductibility of gifts that are going to happen over time. It might even create the opportunity for a deduction today for a gift that happens 20 years from now. And the advisor sees that. That's why they have to play that role of coordinating the other professionals.
I'm having this moment, like I said to I think I mentioned this earlier, but I'm just going to say it again to prove a point. I said to an advisor not long ago, I think alternative investments is possibly as big an impact on a financial advisor's value as shifting to advisory 10, 15 years ago. Like, I think it's that opportunity to level up. I'm also realizing the more I learn about the alternative investment space, the less I actually know. Like, this is actually incredibly significant. I want to come back to the referability piece in a second. Because this is still somewhat new to the retail advisory space, I have to assume that the fixation on the alignment of interests, like advisors are always thinking in terms of what's in the best interest of the clients. But as the bridge, the conduit, the advisor has to be thinking about that too, because there are a lot of people that provide alternative investments that are used to dealing with what they might call the bigger, smarter money institutions, family offices. Now, because of distribution realities, now they're embracing retail. But I don't know if their heart's fully in it in terms of bedside manner in their relationship with the advisor, there are firms out there that have a track record of being the advocate for the advisor. Like this alignment of interest, like as an advisor, making sure that you're accessing and being active in alternative investments, but being very diligent about the firm they're working with. I mean, that's got to be a big deal.
It is, and this is my shameless plug for my organization. I mean, And Partners is built around this concept that the advisor is the client, such that we serve the advisor to better serve their clients, right? We are aligned around the capabilities of the advisor, both on the investment side, including alts and all the things that we're talking about, but also bringing expertise and outside third-party experts to the table to help them navigate complexity and change for their clients, right? So a lot of wealth has been built in this country through real estate, which has some tax advantages. I live in that space, and sometimes the thing that prevents people from unwinding their real estate holdings is the fact that they're going to trigger tax consequences. Well, the alt space has been really forward thinking in this space, leveraging parts of the tax code to help with continued deferral when those kind of things happen, helping people who are active in real estate move to a more passive structure where they can maintain deferral and still be in real estate and get income from it without triggering the capital gain that goes with a sale. And that's where the alts managers and that whole complex have been, in my opinion, really, really helpful to not only provide diversification and smoothing, but better tax treatment for some of these planned events. And I think everything from direct indexing to long-short strategies to Delaware statutory trusts, and there's just lots of stuff happening there that is needed by clients more so than it was 2 generations ago.
Matt, I didn't ask you this offline, so I'm just going to put you on the spot. But if I'm an advisor listening and I'm not part of the And Partners community, but I want to get like a mind map or some type of, just progression on what I need to consider with respect to positioning alts, do you have any resources that you can make available? I know you're a thought leader. I mean, have you created any content that somebody could consume just to start getting their heads around this?
Yeah, absolutely. So the best place to start is our website, andpartners.com.
Okay.
And we have an incredibly talented investment team that has created access to all of those alts that we've talked about and many others. They write a quarterly newsletter on the markets and the role of some of these strategies that people should be considering, and it's available on the website. It's called Prism, but there's some really great thought leadership pieces that have been created there that people could come and see the And Partners difference if they wanted to, on their own.
Okay. And also on LinkedIn, they could find you on
Yep.
LinkedIn, and I know
Absolutely.
you've got some great insights there.
Your clients are hearing more about alternative investments than ever before. From headlines, social media, friends, and other advisors. They are being introduced to private credit, private real estate, private equity, digital assets, precious metals, and other opportunities that may sit outside your current planning process. Your clients are asking questions. The problem is who they call first when those questions arise. If you can't lead these conversations, clients may turn to someone else. Over time, that can weaken your positioning and create opportunities for outside influences to enter the relationship. The Pareto Systems Alternative Investments Masterclass, hosted by Duncan MacPherson, helps financial advisors professionally integrate these conversations into their process without becoming product-driven. Across 4 sessions, Duncan helps you create a 90-day plan, strengthen your professional network, navigate emerging investment categories with greater confidence, and position yourself as the first call whenever money is in motion. The masterclass is available only to Turnkey Advisor members and Pareto coaching clients. Visit the link in the description to become a member, reserve your spot, and access the complete library of Pareto Systems coaching, tools, and resources. Now, back to the episode.
I want to come back to what I was saying around how a lot of the alts are being, like, the conversation is sparked by the client coming to the advisor. And I think 2 that have potential to be disruptive, that really come back down to fiduciary and stewardship, where clients are coming to advisors, and I'm not sure if you're seeing this, but they're asking about precious metals and blockchain. And that is a bit of a sort of a no man's land for a lot of advisors.
Mm-hmm.
Are you seeing that at all, where complex, meaningful clients are coming to the advisor saying, talk to me about blockchain. What do I need to know? Talk to me about precious metals. Are you seeing that?
I'm not seeing it personally, but that doesn't mean it isn't happening. In fact, I'm pretty sure it is happening. It would probably be more of a conversation between the advisor and the investment team, more so than myself. I'm sure that's there. I just haven't personally experienced it much.
I've had conversations where the advisor was asked by a client, like one client was talking about one of their kids being in the AI and just that world, artificial intelligence and all of that, and bringing up blockchain, and then mentioning the Clarity Act, which defines how regulators are going to participate in the world of blockchain. The advisor was completely, unarmed to respond, and just said, I'll let me think this through and talk to some people and I'll come back to you. But that was a bit of a wake-up call. And the other one was a client, pretty significant, who had what he called a sort of a crazy brother, who's been hammering on precious metals. And he said something to the client of the advisor that really got his attention regarding where precious metals is relative to a reserve currency with treasuries, and how much central banks are accumulating gold. And the client said to the advisor, should I be buying some gold? And again, that advisor was, well, let's talk about it. Maybe in our next get together, we can have a conversation about this. I don't know if this is early, if this is going to become a thing. But again, that would be within the sleeve of alternative investments, I'm thinking.
Sure. Yeah, I think our investment team would be very well versed in helping an advisor address questions like that, and also helping people to understand where hard assets or real estate or alts fit in proportion to the other things that people own, and the timing. Because again, illiquidity, which comes with most alternative investments, can be an advantage too, right? But you don't want too much of your investments in a place where you don't have liquidity. And so I think the proportional representation of all of those things should always be part of the conversation. But going back to where we started early on, it's largely that the universe of publicly traded companies is much smaller than it once was. Mm-hmm. And the opportunity to invest in well-run, growing enterprises exists outside of that universe now. And the advisor is charged with understanding what the client's desired outcomes are and then engaging with all the other professionals to help create them.
Yeah, there's just an important signal to noise ratio of zooming out. Like, the public side is shrinking in terms of number of companies. The valuations are just incredible. I think I read, Matt, that after the SpaceX IPO, they purchased an AI company for $60 billion. Or I might not have that right, but it was just, I saw the headline. I was just like, unbelievable, like literally days after. But to your point about liquidity, there's some canaries in the coal mine there. I mean, where what was, some companies who were thought of as being pretty much blue chip, gated redemptions and modified the rules of engagement, the due diligence, the role the advisor can play, and the positioning of advice and planning. It's massive. And it's interesting. In that white paper, I put a little emphasis on the relationship management and the bedside manner, not just the technical. I said to a couple of advisors not too long ago, I said, go onto AI and ask for a 2-page summary of the book, A Short History of Financial Euphoria by John Kenneth Galbraith. He wrote that book in 1994. I think it's timeless, but it's probably more timely today based on the complexity. And the whole premise of the book is affluent investors individually trust the plan, they stick to the process, they're very diligent, they delegate, they follow advice and direction, but then they get with a group of people and collectively, based on FOMO and hype and all kinds of other forces, they kind of, their skepticism gets detached a little bit and they get kind of wound up.
Yeah.
I think this, in terms of fee worthiness and impact to a relationship, the advisor has to understand that dynamic of relationship management. So I don't know if you've read that book, if you've heard of it. John Kenneth Galbraith, he was a economic advisor to JFK back in the day. Just a phenomenal book. It's a short little book. It's hard to get, but the summary you can get, and it's just a reminder of the importance of relationship management and navigating all of this noise.
Yeah, and bringing people back to what the stated objectives are and understanding, not closing one's mind to the fact that things change or why people become interested in things. It's easy to understand. Wealth is being created in vast and varied ways, but it doesn't mean they're all appropriate. And that's why there are rules for who can engage in investing in certain things, right? Because liquidity, again, and risk can't be ignored. And the role of the advisor is to really understand what the client is trying to accomplish and the many paths that might get them there, and the strategies and the other professionals who play a meaningful role in architecting that. Right. And I just think that's the evolution from the we own and offer X, Y, and Z to we are in an advice business with an outcomes focus. And we know there's a lot of noise.
I want to come back to the whole concept of advocacy and deepening client loyalty. Part of positioning is, and I know you're a big fan of best practices and client experience, standard operating procedure for consistency. So we're saying to an advisor, when you're asking a client not to buy something, but to buy into something, buy into a panoramic and all-encompassing, fluid and dynamic process that puts all the pieces of the financial puzzle together, having a placeholder that defines all the value-added services that an advisor provides, not just because they're a good person and they care, but because they thought it through and they built this out. Like it's a proprietary process. Let's buy into this process. My point is, in that progression of these 7 pillars that sort of sustain the process, the value-added pillar, the advisors that do this properly, where they say, you know, part of our process and part of our value-added services that our clients really find to be of value is it will be a sounding board to have conversations about your entire financial life. They could be things that are so far out of our scope and our process, but if you just want another set of eyes and a sounding board to bounce this off, because look how fast the last 5 years went by. The next 5 are probably going to come and go faster. Let's just get out in front of this. That positioning is incredibly rejuvenational for a relationship to, again, make sure the advisor has eyes on to the client's entire array of needs and holdings, but also from an introduction perspective. Saying to a client, look, if you have a friend or a family member, something's keeping them up at night, they've got an unmet need, they just want some validation or another perspective, I'll make myself available. They don't need to become a client. If they're important to you, they're important to me, we'll make ourselves available. I'm finding more and more advisors that represent that professionally and congruently and consistently. The imprinting of that, it can't just be said once. It has to be gently reminded over time. That's becoming forms of introductions where friends of clients are inheriting money, or
Yes.
they're having a concentrated stock dynamic, or they're thinking about selling their business to private equity, or having some form of transfer. That's where the advocate of the advisor is saying, hey, to the friend, I know you're carrying a heavy load here of apprehension and uncertainty. Talk to my advisor. She'll make herself available. You don't need to become a client. The complexity is becoming fuel for advocacy. I'm not sure if you're seeing that in your community as well.
I'm seeing exactly that, and I know we're in concert on what I'm about to say, but the process is the offering. The process is what we're representing to people. There's too much complexity to pretend we have all the answers. We understand where to go and find the answers and who we need to involve in the discussion. The process is the offering. And complexity and change are what drive the need for planning, and those things are accelerating, right? So for example, again, my space is primarily, I'm focused on tax and tax law change and things like that. But simple changes in the law should have big implications to the way people do things, but that doesn't always happen. So, for example, when the Secure Act changed the way pre-tax retirement accounts are inherited, and largely, if inherited by non-spouses, have a 10-year distribution schedule. That should change the way people manage their order of withdrawal, or the amount and timing of their withdrawal. But that still largely hasn't occurred, right? I mean, it's starting to, and you hear a lot about Roth conversions and other things, but I speak to audiences regularly about what happens when one person in a married couple passes away and the following year the surviving spouse is a single tax filer. And that is still news to people, that the same nest egg could potentially be taxed at higher rates only because the surviving spouse moves through the brackets more quickly. And so, to your point, the better an advisor can articulate what their knowledge and experience brings to the table and how it lives within a process for serving people toward their objectives, then the more we break down that paradigm that financial advisors sell investments. And we need to. We need to break that paradigm.
We definitely need to keep going further down that path as the world gets busier and noisier and more complex. And here's the thing, and I know you've been exposed to this in our interactions, but there are advisors that could do 100 things for a client. Like there's 100 pieces of the financial puzzle they could put together over the client's life, but the client's not going to remember 100 things. They just need to remember one thing, that the advisor's got this fluid and dynamic, totally built out process that will put every piece of the puzzle together. Here's another thing. And if a financial professional can, to level up, they can zoom out a little bit. Just go into AI, go into chat, and just simply say, I'm a financial advisor. I work primarily with successful business owners, professionals, and executives. Build me a process that takes into consideration every piece of the financial puzzle I could address and put together for a client, and engages every service provider to make sure they have the complete picture. That prompt, now that's, many issues are 2 or 3 questions deep to draw out the best response, but that prompt on its own can be absolutely baffling to a financial advisor in terms of what it returns to them, where they can say, oh, this is everything I can do, but do my clients know I can do all this?
Right.
So rejuvenating that addressable audience and then positioning it, representing it with prospective clients. If an advisor can just zoom out and then just reimagine how they're perceived, how they're described, how they achieve professional contrast, and where alts fit in their process. You know, our 7 pillars, 1 process approach to positioning. Alts go into the asset management, the wealth management pillar, but they also go into the pillars that take into consideration tax implications, legal, and the value-added services. When an advisor positions it properly within that process, you're right, it's not selling something. It's bought because it speaks to unmet needs.
Yes. Complexity requires expertise and experience and navigation, right? And that the role has become that, navigating the complexities and the changing landscape to keep the outcomes on track. You know, we're helping people to achieve outcomes, and that is an evolution in the role.
Well, I identified a long time ago, Matt, that one of your superpowers is not only possessing the technical ability and understanding the complexity, but in demystifying it. Not just for the advisor, but for the client of the advisor, because ultimately at the end of the day, I think there's a moment of truth that occurs when a client sits in a room with you and a financial professional, and in their inside voice, they say to themselves, they've got this. They don't need to know everything you know. They just need to know that you know. And I think your command of the technical and the way it's communicated and represented, not being killed in complexity, just to the point where a client gets to that realization, they've got this. Because we talk about this all the time, Matt, with our clients. You have to get to a point where you understand and the client understands what it is they want. It's not that they are impressed with what you do. They say to themselves, you know what I want. I know how you'll get me there. That's the alignment. And they buy into that. And what fuels it is the quality of the people, the consistency of the practice, and the thoroughness, the completeness of the process. When a client of a financial advisor realizes the people, the practice, and the process, and by virtue of contrast, like the advisor I'm thinking about leaving to come to you, or the other advisors who are trying to steal me away from you, they don't have that, I'm in, and I'm staying in. I don't know, not to oversimplify it.
Well, and I do agree. And I think the best advisors have a high degree of humility that makes them great listeners and empathizers, and they don't feel the need to have all the answers, but they know where to go when they need expertise outside of their own. And that gives clients a lot of comfort. That's why when advisors change firms, the clients follow. It's always the fear if an advisor is going to make the change, that what if my clients don't follow? But overwhelmingly they do, because of what we just described, is the humility and the commitment to the craft and the process. Clients don't want to start over when they know that you have a good process and you've navigated complexity for them. They don't want that to change.
Okay, Matt, that is one of the more profound things I've heard in a long time. And first of all, I completely agree. The other side of that is because the most enlightened advisors are governed by stewardship, not salesmanship, sometimes they do drift into this pattern of understatement that is part of the humility, where they become their own best kept secrets, where they don't go there. They don't know how to talk about certain things. So they don't want to disrupt the relationship. They don't want to come off the wrong way. When an advisor emphasizes the people, the practice, and the process, and they keep imprinting that value, they don't have to have bravado. They can maintain the humility, but just getting the client bought into the process. Because ultimately the KPI, in my view, is when a client starts asking you the question, hey, alternative investments, that's part of the process, right? They're not saying, hey, I just bought into something with a buddy. Oh, I didn't know you did that. Or, I just bought long-term care from somebody else. Oh, you do.
Right.
It's part of the process. When the client understands the panoramic and overarching completeness of the process, and they just keep buying into that, the advisor will always be the first call. They'll always achieve total client engagement, and they'll maintain their fee worthiness. A client will never focus on what the advisor costs. It's always what they're worth. So that point about humility is massive. And we don't want advisors to change from that. We want them to be understated, but don't be your own best kept secret. Don't be the iceberg.
Yeah, and we want them to facilitate the partnership that's necessary among professionals and be part of the planning and the liquidity events instead of being downstream from it, right? So early in my career, I would potentially maybe be the advisor hoping to invest the proceeds from a liquidity event. But today, the advisor has to be helping to navigate and plan for the liquidity event, right? It's just a different role than the one that was born in the era where self-funded retirement was really the issue of the day.
Mm-hmm. Well, and the thing that kept a client up at night back then is just, am I going to have enough? Am I going to outlive my money? Right. Now it's just, there's so many moving parts, and the words matter, Matt. I mean, we don't want advisors saying, hey, we will refer you out. No. The words matter. We will engage every service provider you need into the process so you have the complete picture. And that downstream dynamic you're talking about, that's part of the first call, eyes on dynamic, where now the client is going to any service provider saying, you've got to talk to my advisor. When a client introduces another service provider or another provider of any kind, or a friend or a family member to the advisor introduction, it's because they've got a process in place, in my view.
Yes, and they've earned the trust of the client. So that invitation to meet or engage with another professional is warm, right? The advisor leads that process. I couldn't agree more. I think it's the most noble work, and it continues to become more central in the lives of people because they have more complexity and they encounter change more rapidly than ever before. That requires advice, expertise, planning to navigate it. And it's really important work, and it has a profound impact on people.
Well, you just reminded me of another conversation I had with an advisor long ago. He kept talking about trust. And I said, okay, I'm your client. I've been your client for 15 years. Let's just say, I'm thinking about you right now. What do I trust? If trust is so important, what specifically do I trust? Everything this advisor mentioned spoke to a quality or a skill or an intention, right? Moral compass, judgment, all of these things that aren't proprietary. They're important, but they're accessible somewhere else. I said, yes, everything you just said is important. There was a time it was enough. Now, minimum requirement. I want your clients to trust your practice and your process as much as they trust your skills, qualities, and intentions of a financial professional. Panoramically, all of it equally, not just you, the entire scope. Trust. Just reimagine trust. What do they trust? They trust the process. And here's the KPI on that. Financial advisor gets a referral, meets with the friend of the client, it's phenomenal, calls the advocate, the rainmaker, and says, hey, I really appreciate you introducing Matt to me. We had a great conversation. I just have to ask, what happened? Tell me about the scenario. What did you say? What did he ask that prompted the introduction? When a client says to a financial advisor, when they start mirroring back their value, when a client says, well, Matt was talking about some things he's got coming down the road, and I just said, you've got to talk to my advisor. He's phenomenal. He's knowledgeable. He's honorable, but he's got this process in place. I've just never felt better about the path I'm on. When they're actually representing the advisor's value in a referable moment as being proprietary, not just, hey, he's a great guy, he's smart, I really trust him. Table stakes, but the entire scope of value, that's next level, in my opinion. And again, that's engineered by all of this.
And it takes away the need to be proximate, right? Trust and likability and being local were very important components as we became a nation of investors. Now it's what you just said is this person specializes, focuses on, has a process for, or the resources for what you're about to navigate.
That's so well said. Incredible. Matt, first of all, I want to thank you for your time because, again, I know you're in high demand. Find Matt on LinkedIn. Find him. You can go find him on the And Partners website. I want to do another conversation at some point where we're talking about this through the advisor's lens around them getting out in front of their own continuity and succession plan, their own dynastic realities, their own pursuits to charitable giving and benevolence, all of that. Because financial advisors are becoming some of their most significant clients in many respects. So I want to have that conversation. We're probably going to go deeper on the alternative investment space down the road, but invaluable insight. I really appreciate it.
My pleasure. Thanks for having me, Duncan.
Thank you for listening to Always On with Duncan MacPherson, where our objective is to enable professionals to always be working on their business and on themselves. Want to learn more about Duncan and his team? Visit ParetoSystems.com. Don't forget to click the follow button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and/or guests and does not necessarily represent the views or opinions of Pareto Systems. The content has been made available for informational and educational purposes only.